So mortgage rates are finally down. Let's talk about the Fed. Today I'm here with Brad, the mortgage guy from Rate Mortgage.
That's me.
Thanks for coming in today.
Absolutely.
There's been so much talk about interest rates, and they're finally coming down and tied around that September 19th Fed meeting and
Sure.
more meetings coming forth. How does that actually influence rates? I know it's not as cut and dry as it sounds.
No, yeah, it's not quite. But I mean, there was a lot of excitement around mid-September. Everybody was like, oh my gosh, rates, they're finally coming down. The Fed had not reduced interest rates in over 4 years. So we'd seen a lot of increases, but not a lot of decreases. So really, really excited for that. Now, what a lot of people did on the 19th is they would call me up and go, hey, is my rate now 0.5% lower?
I got those calls too.
Yeah, absolutely. So that is not the way that it works. So just from a 35,000 foot view of the rate market, like you're up in there in the plane and you're looking down, you can't really identify what's down there.
Yeah.
You're up real high. The Fed rate reduction had already been taken into account probably 60 to 75 days before the actual cut happened.
So it was priced into the market already.
Yeah, already priced into the market. Mortgages are a long-term debt. The Fed funds rate is the overnight lending rate that a bank has to have a certain amount of money in reserve.
Right.
They put it in reserve with the Federal Reserve. And if they have money over that reserve requirement amount, that money they can lend out to other banks who need additional reserves. Overnight, super nerdy here.
That makes sense. You take that, how does that then correlate into rates? Like, how is that even an influence or a correlation at all?
Yeah, so I'm going to come back to that in a second. If you think about that as ultra short-term borrowing, right? Mortgages are long-term. So they're actually looking ahead and saying, hey, what are the rates going to be over this 5, 10, 15, 20, 30-year mortgage, right? What are the rates going to be like? And most people don't keep a loan for the full 30 years. So they're not really looking at the entire 30 years most of the time. But there is that risk that a loan will stay out there. I mean, there's a risk that somebody got in the 2% back a couple of years ago, and they're going to keep that thing forever, right? So anyways, all that's priced in, and it's long-term debt. So really, when the Fed announces that they're going to have a reduction, or when the Fed signals that they're going to have a reduction, or when the markets anticipate the Fed having a reduction, it's immediately going to be priced into mortgages, right? So by the time the Fed actually has the reduction, it's not going to have any impact whatsoever. In fact, on the mid-September meeting, when they reduced those rates by 0.5%, the markets were gambling and saying, we have 100% certainty that they're going to reduce 0.5%. So if the Feds had reduced that rate only a quarter, the rates would have actually shot back up.
Shoot back up.
Yeah, absolutely, which is weird. The Fed reduces rates and rates go up.
It's hard to wrap your head around.
So the markets are actually reacting. And in that meeting, they even said, hey, we think we're going to have a couple additional rate cuts before the end of the year. After the meeting, there's an anonymous plot chart that goes on where the Fed members, they vote and they say, here's where I expect the Fed funds rate is going to be, right? Not mortgage rates, it's separate.
Right, different.
Different. And they all vote on that. And so people look at that and the markets look at that and they say, okay, based upon the projection of these Fed governors, we anticipate this is going to happen in the future. And mortgage rates already start to react. So rates were as high, I think maybe sometime around this year, high as the 8s. They were up into the mid to, low.
And even like in the 7s in April, not that long ago.
But without the Fed even doing anything, rates had come way down. And why is that? Well, because the Fed would start cutting those interest rates, right? The economy was signaling that the inflationary pressures were disappearing and so on and so forth.
Okay, so a sign that the Fed is cutting rates, and that, of course, is affecting interest rates. I mean, is that a sign that we're in, better shape as an economy or inflation's being curbed? Like, what is that all signaling? Is that's a healthy move?
Yeah, it's a healthy move. It means the economy is getting to where the Fed wants it to be. Now, that doesn't mean it's healthy for every individual because in reality, the Fed wants a little bit higher of unemployment, right? Which doesn't sound good. Yeah, that doesn't sound great, but they do because there is considered a healthy range of unemployment. Unemployment being too low, that could have inflationary impacts on the economy. So they're actually trying to stall the economy. By increasing those rates, they're actually trying to stall the economy.
Right.
So think about it this way. It's not just on the mortgage market. Everybody's looking to do something with their money, right? If you have extra money, you're putting it in a savings, you're putting it in treasury bonds, you're putting it in the stock market, you're putting it in mutual funds, whatever it is.
Real estate.
In real estate. All right. I like that. And the returns for people who have done that have been absolutely phenomenal. Honestly, over the last probably 11, 12 years, it's been a really, really crazy run. So by increasing that Fed funds rate, when banks have extra money in their reserves, are they have options of what they want to do with that. They can invest it somewhere. They could write a mortgage for you or for me, right? They could say, okay, I can either do this, lend to my fellow banks through the reserve, right? Or I can take those extra monies and lend them out in the form of mortgages, right? So it's considered very low to no risk to lend inside of that reserve, right? So let's say that rate's pulling them in, say 5% there. Well, if they want to take a little more risk with mortgages, which are also considered pretty low risk, they might be willing, though, to take on that extra risk for a 6.25% or 6.5% rate, right? So it's not directly related, but it does have to do with what are the banks going to do with their money, right? You got all these banks doing those high yield savings accounts. That's how they're doing it. They're determining how they're going to invest their money. And those people who are giving out those high returns are investing their money usually in really, really, really safe return stuff that they can guarantee with their return. So then they can guarantee their depositors a return.
So we're really focused on the Fed and the Fed rates. Are there other things that are influencing mortgage rates? I mean, is it all really directly tied to that Fed?
No, there's just so much to it. It's everything, because you're talking about the Fed funds rate. People can invest in treasury yields. They can invest overseas. They can invest in real estate.
Right.
And so to get people to invest in mortgages, to get big 401ks or big pension plans or big, investors to invest in what are called mortgage-backed securities, you have to offer up a rate that's going to be attractive to them. And if they have other things that are offering them a higher rate, well, the mortgages are going to have to adjust. So if other things are in a bigger return, mortgages have to go up to adjust to attract the money to that marketplace. Right. So there's so much involved. That's only the economic forefront. Forget about the geopolitical forefront. We had just recently, or not just recently, it seems to be an ongoing thing, Iran, Israel. There was a fear that that was going to interrupt oil. Oil is delivery. Oil is your cars. Oil is the Amazon guy coming to your door. Increased prices is what? Inflation. Yeah. So even just that actually impacted rates, and rates popped up about 0.25% because of that. The longshoreman strike that was happening, that just got pushed back until January. Same thing. We can't get inventory in. What's that going to do to prices of stuff that's already here?
Well, right. And you keep talking, we keep focusing on what the Fed's doing, as far as what's going to happen to rates. And those things are complete left field.
Absolutely.
Yeah.
Absolutely. Economics alone, I think rates should start coming down very, very slowly. However, all the geopolitical stuff you can't predict. You couldn't predict when Russia was going to invade Ukraine. You couldn't predict when there was a hostage situation over in Israel. You couldn't predict that stuff, right? And that stuff has a huge impact because it also impacts inflation, and inflation is going to have an impact on rates. There's actually some now saying that the Fed may have reduced too much in September, believe it or not. And again, that's why rates popped up a little bit. Right.
So what's happening in the world, actually, even though we keep saying we're going to have all these Fed meetings and they're going to be cutting rates, and I mean, what's happening in the world is going to affect the Fed's decision. So ultimately, if people kind of start listening to what the Fed's doing, what they're anticipating, that can directly correlate, in your opinion, to being a time to maybe call you and say, hey, is it time to refinance my home? Or maybe I should hop back in the market. I mean, is that the trigger we should be watching for?
I think if the Fed is indicating that reductions are coming, and then also those reductions do happen, it is an indication that as a whole, the economy is healthier.
Right.
And so with a healthier economy, I do think those rates are going to start coming down a little bit. I don't know that anytime soon. I think a lot of people feel that rates, they're not down until they're in the 3s or the 2s again, right? Like, I don't think that's happening soon. I don't think you'll see that. Right. I'm not going to say you're not going to see that again in our lifetime. I have no idea. There's no indication that would. So if it was all just economy and we didn't have any other conflicts in the world or any other disruptions for oil, disruptions for shipment, disruptions for whatever it is, these hurricanes are huge. These are going to have an impact on insurance. Insurance has an impact on your housing costs. Housing costs has an impact on your housing value. Domino. Right? Insurance cost goes up. Maybe there's people who can't afford their mortgage anymore. There's just too much almost to even predict all of it with 100% certainty.
We only have a crystal ball.
Yeah, but that's what the markets are trying to do. They're trying to determine all that. So when they hear about that unrest in the Middle East, they're like, oh, shoot, that's inflationary. Rates come back up.
Right.
Oh, okay, that's been quelled a little bit. All right, that's good. We got that under control. They come back down a bit. Meanwhile, the economy is still just chugging along with doing what the economy's doing. There's other things just coming in and just hitting it. All of it impacts mortgage rates.
Right.
Because it impacts where you invest your money, right?
Yeah. That makes sense.
Like people don't understand that. You're really, when you get a mortgage, you're actually giving yourself that money, because the money you have in your 401ks and your Roth IRAs and your SEPs and your retirement accounts and your pension
It's all
plans,
being lended over and over and over again.
yeah, it's all funneling money into the mortgage market.
Right.
And all those investment vehicles are buying mortgage-backed securities. So they're all saying, hey, we don't want to buy a 2% investment. Okay. All right. Then what if I give you 3%?
Right.
Oh, no, you don't want that. Okay. No, what if I give you 4? What if I give you 5? What if I give you 6 or 7 or 8? Those rates really just adjust to continue to attract the amount of money that's needed to keep the market going.
Right.
So, where else can you invest your money? Mortgage rates just follow that, but there's everything. You could be trading currencies. You could be trading.
Right.
All of this stuff is competing.
Right. It's all competing.
Yeah.
It's all where people are putting their money.
Correct.
Yeah.
Exactly.
This impact of the Fed and this impact on interest rates coming down, there's a VA loan, there's conventional, there's FHA.
Sure.
I mean, does it impact all of the loans equally, or can we look for better rates in certain products?
Yeah, I would say yes. It impacts all loans equally, but that does not mean all loans start at the same spot. So
Okay.
believe it or not, government loans are considered to be a lower risk loan.
Okay.
Okay. So FHA, VA, USDA are considered to be very, very low risk loans. VA actually is considered to be the lowest, which seems counterintuitive because
It's 100% financing.
Yeah.
But we just closed a VA loan with like an incredible rate, like the fives. Like it was
unbelievable.
great.
Yeah. VA is awesome. We have no lender fees on VA. The rates are super low. It's a great, great loan. So not all programs have the same rates, and there's no one rate for a program either. Right? People call up and go, what's your rate? It doesn't matter what my rate is. You know what matters? What is your rate? What's your credit score? What's your down payment? What's your housing history? What's your debt to income ratios? All this stuff is built into your rate, not what my rate is. It's what your rate is. And it's all based upon risk. Lower credit score, higher rate, right? Lower down payment, higher rate. Lower debt to income ratio, lower rate. More reserves, you potentially could get a lower rate. Lessen the risk to the lender, you're going to get a little bit lower rate. Why is that? Because again, I'm looking to invest my money. Okay, you can invest it in something that's considered a B risk.
Right.
I'm just throwing these numbers out random. I want more return to take a risk on a B grade investment than I would require for an A grade investment, right? So I'll take this investment knowing it's a lower risk. I'm older, I'm retired, I want some more guarantee. I'm younger and I'm trying to build and I have time before retirement. I may take those higher rates. So bottom line is not every loan program has the same rates, but yes, as the rates come down, they're all impacted. If you got two programs and they're here, they all come down and they all come down and they all come down and they all go
in
up.
relationship to each other.
Yeah, in relationship to each other, exactly.
That makes sense. I think we were in the 7s in April, right? Maybe. So now we're looking at this new landscape. I mean, how is that all impacting affordability?
One of the problems that we're having as far as affordability is that the housing prices have continued to go up, right? But yeah, I mean, somebody who could afford $300,000 back in April probably is now somewhere in like the 325 range with the rate reductions. Same payment, same everything.
That's huge. That's huge in a couple months.
Yeah, absolutely.
Yeah.
Somebody at 100, maybe they're at 550 or 600 at this point, right? Because of that. So that's a relatively decent jump.
Okay, so what's your advice that you're giving to buyers right now that are talking rates to you?
Yeah, I mean, some of it might have to do with where you're at geographically because there are different markets.
Big time.
Yeah, all over the place, right? You do have some markets that are actually seeing price decreases right now.
Like Florida, Texas.
Yeah, you've got some areas in Florida and Texas. Now, again, but that's not all of Florida.
Right,
That's not all of Texas. Yeah. That's not all these areas. There are certain areas, though, that are seeing some of that stuff. So I think in general, though, nationally and definitely in the Northeast where you and I are located here, you're still seeing prices go up and you're still seeing inventory shortages. My advice to people is you better jump now, right? It's the same advice I said to them 2 years ago when they thought the prices were too high, and 3 years ago when they thought the prices were too high, and 4 years ago when they thought the prices too high. And some people literally have been sitting on the sidelines for 4 years waiting for the prices to come down, and they've gone up 50, 60%. Right. The issue that I think buyers are going to have in markets that have a supply and demand problem, meaning there is way more demand than supply, is that reduced rates are only going to increase demand.
Right.
But it's not necessarily going to increase supply.
Right.
Now, some might say people who currently have those 2s and 3s are going to list their houses once rates come down because they're kind of stuck. They don't want to move because they don't want to lose that
Hate
rate.
their house, love their rate.
Yeah, absolutely.
Right.
And that's great, except that if I'm selling a house, I'm also buying a house. So I'm putting another house on the market. But
For the most part, 1-to-1.
yeah, I'm putting another buyer into this pool as well. Right. I think right now in spots of the country where there's an inventory shortage, I think that smart buyers are jumping now because smart buyers are listening to everybody who's saying the rates are already down in anticipation of the cuts.
Right.
They're jumping in now, whereas the average person is going to jump in after November, December, January when they see more cuts happen.
Right.
But they expect the rates are going to come down because they see the Fed cuts.
Right.
And they've already happened.
Right.
They're already here.
And so more buyers are jumping in, more buyer demand. Inventory is not necessarily solved.
There you go.
It's harder to buy.
Yeah.
Upward pressure on pricing.
Absolutely.
Yeah.
If you have 10 houses on the market and 100 people competing for it, that's why everything's going up in price, right?
Yeah. Supply and demand.
100 people are competing for 10 houses.
Right.
Right? Imagine when that turns into 200 people for the same 10 houses.
Right.
There's going to be somebody else in that 200 people who has more money than you.
Right.
And is willing to spend a little bit more.
Right.
Right.
Waive everything.
Correct.
Right.
Correct.
And that's where we started to see some of the contingencies going away.
Yeah.
So in your opinion, the risk of waiting is increased prices, increased competition.
Everybody looks at an investment, like a house is an investment. So everybody looks at every investment and thinks, man, I wish I got in. I wish I got into NVIDIA 3 years ago. I wish I bought Bitcoin when it was 10 cents a coin, right?
Yeah,
Like
right.
everybody looks at that stuff, but that same person who didn't buy at 10 cents a coin went for Bitcoin, and I'm no Bitcoin expert here, but using it as an example, but the same person who didn't buy Bitcoin at 10 cents a Bitcoin also didn't buy it at $1,000 a Bitcoin because they thought, that's crazy. It's already had its run.
Right.
And now I don't even know, 65,000. I don't
even
it's
know.
up there. So the same thing I think is applicable to the housing market right now. Everybody's concerned about a crash. That's a concern. But in areas where there is such an inventory shortage, unless those areas have some plan to increase supply, 2 years from now, you're going to think prices today are an absolute steal.
Right. I talk a lot about, basic supply and demand economics. If you're just going to focus on that and how many months inventory and 6 months being considered a balanced market. So more than 6 months buyers, less than 6 months sellers.
Yeah.
Most of our markets here, we're 1.5 months inventory.
Yeah.
So how much inventory has to come into the market even before we hit balanced market, not even swing into a buyer's market? We're a long time from that. There has to be some pretty big swings of something happening left field to even get there. Yeah.
And you have some states making accessory dwelling units legal.
Massachusetts. Yeah.
Absolutely. Their whole idea is that it's not just houses that people buy. Housing is still driving the costs, right?
Yeah.
If there's more housing, even rental units, that takes people out of the buyer pool and puts them into a rental. Everybody needs a place to lay their head. Right? Everybody needs a place to cook, clean, shower, all that stuff. So adding that accessory dwelling unit absolutely increases supply, not for something to buy, but increases supply, another pillow for somebody to lay their head on. So they're looking at things like this, but we're just not building in the Northeast
rate that we need to be.
And the places that we mentioned, like Florida and Texas,
the new construction.
There you go.
It's the new construction.
Absolutely. So they're building like crazy, and they're pumping in supply, and now the demand's not keeping up.
Right.
So that's why you're seeing the opposite effect there. So unless you really think that your local town, state, government, whatever, have some kind of a plan to increase supply a lot, there's a pretty good chance that your investment in a new home is going to be safe, and you'll be wishing 2 years from now you had purchased.
Right. So what I'm hearing, which I actually say all the time, is the best time to buy is when it's right for you, because you're never going to be able to perfectly time the market.
Absolutely.
Yeah.
You need a place to live. You need a roof over your head.
Right.
It's a need that people have. So the right time is exactly what you just said. When it's right
when
for
you're
you.
ready, right.
Yeah. Don't try to time the market. Don't try to do any of that stuff.
Right.
If you can afford the down payment, and there's a lot of programs that can help you afford that.
Yeah.
A lot of programs.
Yeah. Locally, Connecticut and Mass have some
Absolutely.
really strong programs.
Connecticut,
out there.
the time to own funds will come back, 25 grand. Massachusetts has a $30,000, up to $30,000
Mass housing
program.
is an incredible program.
Yeah. New York's got one that gives you up to 15. Florida's got some.
Yeah.
I mean, honestly, I could just name every single state. Every state has something. We've got them all. But so there's money for that stuff. But the right time is when you have the money to buy, whether that's out of your own funds or using one of those programs, and when the payment's right for you. If the payment is right for you, get into the place.
And then you refinance later.
Yeah, sure. Absolutely.
If that makes sense.
Yeah, but don't count on the refinance is what I always tell people. Like, you want to be comfortable with your payment.
Right.
And as long as you're comfortable with your payment, 5 years from now, if you want to refinance and you can save a couple $100, you're going to be even more comfortable with that payment.
Right.
Or maybe you want to upgrade. I don't know. It's a weird phenomenon right now where people are trying to skip their starter home.
Right.
Your first home is an investment to help you save for your next home, right? Like, by putting $15,000 into the purchase of a $400,000 house, you now have an asset that's growing and it compounds. But the first year, let's say appreciation was only 3, which would be really low for what we've experienced the last even 11, 12 years. 3%, that's 12 grand a year.
Right.
Right. So you put in 15 and every year you're getting 12 and then 12 and a little more and a little more and a little more because of the compounding effect.
Yeah.
In reality, that's like the average appreciation over, years and years and years. Like, use that
as your stepping stone. Yeah.
Stepping stone, springboard, whatever you want to call it.
I was thinking of even like my journey where it's like my first condo. I wanted to go New York City and pay high rent and be really cool. And my sister was like, you're buying a condo. Yeah. You're buying a condo. It was avocado green, everything.
Yeah.
But guess what?
Now that's in again, isn't it?
I know, it's back in. It's back in.
All right.
But, I was able to use that to leverage that into the next home. And then the next home, helped us buy investment property. Like, how just that one seed, turns into the next investment, and how you can leverage your equity to do some really good things for your overall net worth and for making moves.
Yeah. I mean, imagine if you had thrown away that rent in New York City, you would have foregone like tens of thousands of dollars in equity that you built.
In 2 years.
In 2 years.
In 2 years. Yeah.
I mean, seems obvious to me.
Yeah.
So anyway, the right time is
when it's right for you.
When you're ready.
Yeah, when you're ready. Yeah.
Do you have the money to buy, and is the payment comfortable?
Yeah.
If those two things meet, I think it's time.
I think it's time.
Yeah.
Okay. So we got off topic because we're both in real estate and we love to talk about this stuff. But going back to rates, what advice do you have for people in like locking interest rates? Right now they're thinking of buying. What do you consider the best advice to give them on that is?
Okay. So there's two areas that we talk about here.
Yeah.
One would be long-term locks, like new construction, you can do long-term stuff.
Right.
I probably wouldn't suggest that. I think we're in an environment where we are seeing rates come down.
Yeah.
Is there daily volatility? Absolutely. But the daily volatility, it's like, it's going like this, right?
Like,
it
might be a bumpy ride.
Yeah, it might be a bumpy ride, but it's not doing this. It's bumpy and it's going like we had a 0.25% rise this past week again.
Right.
So I wouldn't suggest any long-term stuff with new
Some
construction.
banks lock a year.
We do that, yeah.
Yeah, but that doesn't make good sense.
It costs
right
you
now.
money. I just don't think it's a great investment right now.
At the time.
When you are buying a house, you get something under contract, I suggest everybody lock immediately, right? And back in my prior life, it was a little bit more of like a gamble. Like you were like, oh no, maybe we should wait to lock until the end of the week. I think rates might come down a little.
I think we're all conditioned to that.
I don't know. It's
like
going to go up.
When are you going to lock? When's the right time?
So I think what you need to do if you're out there and you're buying a house is you need to ask your loan officer if they offer a rate float down. And that I think is really important. That is something we do. That is something relatively unique to us. I'm not saying nobody else offers it, but there's, the majority do not, is all I'll say. There's definitely others that do. So ask your loan officer if they offer a rate float down. If they do, just lock it. If they don't, maybe get a second opinion.
So when you say float down, so that means you lock it today, and if between then and the closing date it lowers, you float.
Yeah, exactly. Now, every lender is going to have their own rule as to how much it has to come down. But basically what it says is, we lock today, I'm taking you out of this crazy market, basically creating a ceiling. You're not going to go over this because I've locked you in, right?
That makes sense.
And usually that's the rate you're getting. Like if you lock in, that's the rate you're getting. If rates go up, great, you won and you still were locked in. But if rates go down, you lost a little bit because you now don't get the benefit of that lower rate. With the float down, you are able to get that lower interest rate if rates drop before you're closing.
That's awesome. So it's really low risk. I mean, again, if you're comfortable today, if you're comfortable with your payments today that you're going under contract, it can only get better.
Yeah. So ask your loan officer if they have a float down option. If not, maybe find a loan officer that does. Hit me up. I mean, I think that's really important because I used to hate 20 years ago having a conversation with somebody like that. Should we lock? Should we not? Well, let's watch the market. What the heck do I know? And also, how do I know when in the Middle East that's going to disrupt oil, that's going to disrupt rates?
We talked about that before. There's too many factors.
It's crazy.
Yeah.
I'm not omniscient. Lock the thing in, get it locked. You're under contract. Do not go to sleep nervous and anxious, and that's it. And then float down if the rates get lower.
Now let's talk really quick refinancing, because a lot of people have bought now, at the eights. They have an 8% rate, or, and now rates are down on the sixes. We might get into the fives next year. So how big of a percent cut in rates does it make sense to start saying, all right, maybe it's time to revisit a refinance and get that lower rate?
Yeah, so that's going to depend on several factors. One of the major ones, though, is going to be your loan size. Like a $100,000 loan saving 1% just isn't enough, but a $2 million loan saving 1%, that's a pretty savings, right? So there are costs to refinancing. There's attorneys, there's recording, there's all this stuff. I would say that you should reach out when you're seeing the averages, maybe 1% or so below where you're at right now.
Okay.
But that does not mean it's time. You may reach out to your loan officer and they may tell you that it's not time yet. And I hope they do tell you that, right? I hope they do tell you realistically, it does or does not mean. Now, depends on a lot of things, though. Like we have a rate ride down program where we can do some no costs refinances, where basically if you've purchased a year ago, I can put you into a 29-year loan, refinance, pay the costs, and if I can still save you money without increasing your balance, that just automatically makes sense, right? And so I've got people doing that right now. Primarily VA, there's some reasons for that, but primarily VA is a good candidate for that program. But a lot of different options. If you trust your loan officer and feel that you got good service from them the first time and honest communication from them, you should be able to call and be like, hey, where are we at right now? Does it make sense? And if not, they should be able to tell you based upon your scenario when it would make sense.
Right. Once we reach 5 and an eighth or 3. It's
I've got people calling me, probably a few dozen people a week. Hey, is it time to refinance? No, it's not. Not even people that I did the purchase loans for. Those people are already in a system and they're getting communications from me telling them where they should be. Some of those are reaching out too, but people who I didn't purchase with me, calling me up and I'm saying, okay, let me look at your statements.
Right.
I might know when I have a conversation that you're not in a position to where it's going to make sense.
Right.
But I'll still say, send me over your statement. I'll take a look at it. We'll hop on the phone. I'll explain to you why you should ignore the millions of phone calls you're getting right now to refinance.
I'm sure.
Right. Because people are, we have a 4% interest rate. Okay, you can do that with $20,000 worth of fees.
And points and all this.
It's crazy.
Yeah.
It's stuff you see. But then we sit down and we just review that statement and say, okay, here's where you need to be. And then I'll put you in a system. So when we're there, I call you and we go.
Right. That makes good sense. All right, Brad. Well, thanks so much for coming in today. So just real quick, you're licensed in Connecticut, Mass. You talked about Florida, New York.
Yeah, licensed nationwide, not Utah, but we'll get there soon. Licensed nationwide, Anybody looking for advice for purchasing, refinancing, I can hook them up. Anybody looking for real estate agents in their local market, I know you can hook them up. You have an extensive database of people you've worked with in the past and people you have met throughout the year. So
throughout the country. And what's really great with you being licensed in all states is that we could have, the local lender relationship, and then we can connect you out to other agents. So that's great.
I just got an actual text this morning from a past client of mine. Hey, do you work in Texas? Yep, I do. She's getting relocated. We can help you out wherever, get you pre-approved, move you anywhere, looking to refinance anywhere. That's what we do. All
right. Well, thank you for coming in today.
Absolutely. You want a high five? Should he shake?
Sure.
Bump elbows?
Bump elbows.
I don't know.
Okay, it's awkward. Okay.
We'll do the other side.
Oh, we're doing it again. Even more awkward.
Yep.
All right. Well, cool. All right. Well, thank you. Hearts. All right. That's it. That's a wrap, guys.
That's a wrap. Let's do it.